I want to tell you about a guy named Jake. Not his real name, but this is a story I've watched play out more times than I can count. Jake had been trading for 3 years. He had a notebook full of setups, he'd read over 30 books on technical analysis, he glued himself to the charts from the opening bell until well after the closing bell every single day, and he'd personally backtested hundreds of candlestick patterns by hand. And after 3 years of all that effort, his account had barely moved. Here's the strange part. His roommate, Tyler, had only been trading for 8 months. Way less obsessive about it than Jake. And yet Tyler's equity curve was climbing steadily. The difference wasn't who worked harder. Jake was pouring all of his time into fixing something that wasn't actually his problem, kind of like a guy with a bad back who keeps going to the dentist. Tyler, with way less experience, had accidentally stumbled onto the one thing that was actually holding him back. This video is going to break down why that happens, and give you a way to diagnose yourself before you burn another hour fixing the wrong thing. Trading doesn't give you an honest mirror the way most skills do. If you're learning to drive and you turn too late into a corner, you almost hit the curb, the feedback is immediate and impossible to argue with. If you're learning to cook and you oversalt the dish, one bite tells you everything. The market doesn't work that way. You can analyze something completely wrong and still get bailed out because price happened to move your direction that day, and you walk away thinking you're skilled. Or you can do everything by the book, follow every rule perfectly, and still get stopped out by one random wick. That noise is exactly why so many traders like Jake spend year after year circling the wrong problem without ever realizing it. So instead of guessing, here are 4 categories of problems that traders run into, and they tend to show up in this order, roughly matching the order Jake and most of us go through. 3 years ago, Jake was actually stuck in this first stage without knowing it. He'd bounce from Fibonacci retracements to ICT concepts to news trading, giving each one a few weeks before abandoning it. His problem back then wasn't discipline or psychology, it was that he'd never actually proven any single approach made money over a real sample size. Call this the missing edge stage. Here's how you spot it. Your results this month look nothing like last month, with no discernible pattern. You've had a losing stretch longer than a few weeks with no clear reason why. You're switching strategies every week based on whatever's trending on YouTube or TikTok. And if someone asked you why your setup actually works, all you can offer is a feeling, not a number. If a couple of those sound familiar, you're standing exactly where Jake was 3 years ago. There's no shortcut out of this one. Pick a single approach, log at minimum 50 to 100 trades, on demo or backtest is fine. Note the market conditions each time and tally your actual win rate as a number, not a vibe. Jake later said the moment that changed everything was sitting down, filtering through 200 old trades, and realizing one particular pattern crushed it during the Asian session but bled money during the New York session. That was the first time trading felt like a skill instead of educated gambling. 6 months after finding a pattern that actually worked, Jake ran into a completely different trap, and honestly, this might be the most frustrating stage of all. He had a method that was provably profitable on paper, but his live account still wasn't reflecting it. What was actually happening? Every time his exact setup showed up, Jake would not take it, or he'd take it and bail early out of fear, or he'd hold a loser way past his stop because it'll probably come back. He didn't lack a formula. He lacked the ability to follow that formula the moment real emotion showed up. A lot of traders in this stage blame themselves for having weak willpower, then go hunting for psychology courses, meditation apps, self-help books. None of that is wrong exactly, but it usually misses something bigger. People who execute well aren't people with iron discipline. They're people who've built a process that makes doing the right thing almost automatic, the same way you don't need willpower to put on a seatbelt anymore. It's just what you do. Signs you're in this stage. When you go back and look, your best trades line up exactly with your plan, and your worst losses happen completely outside of it. You keep hearing yourself say, "I knew I should have waited, but I jumped in anyway." Your backtest shows a positive number, but your last 3 months of live trading show red. The fix here is to write out, on paper, not just in your head, 3 to 5 non-negotiable conditions that have to be true before you click the button. At the end of each day, score yourself on a scale of 1 to 10 on how closely you stuck to the plan, not on whether you made or lost money. Jake tried this and found something unexpected. Every night he'd slept badly. His adherence score dropped below 5. So he changed his sleep schedule around any major trading session. a small tweak that made a noticeable difference. This is the stage Tyler, Jake's roommate, is currently dealing with, even with only 8 months of experience. Tyler's method is solid, his discipline is good, but he only gets 4 or 5 qualifying setups a month. With that few opportunities, even a great win rate produces a pretty thin bottom line. Picture opening an incredible restaurant that everyone who tries it raves about, except it's tucked away in an alley nobody walks down. The problem isn't the food. The problem is nobody knows it's there. A lot of traders at this stage go the wrong direction. They'll spend a whole week trying to push their win rate from 62% to 64%, when what they should actually be doing is adding 2 or 3 more currency pairs, or 1 or 2 more trading sessions, to multiply the number of valid signals they're seeing. The tell, your method is profitable, your discipline is solid, but your account growth has flatlined simply because there aren't enough setups showing up. You spend most of your day waiting, not trading. The fix: instead of asking, how do I squeeze a few more pips out of this trade? Ask, where else does this same logic still apply? Build more alerts, more scanners, and look at markets or time frames you've been ignoring where this same edge might hold up. The final stage, and arguably the most dangerous one because it can wipe out everything built in the first 3 stages. Mismanaged risk. There are 2 completely opposite versions of this. One version, you're too cautious, sizing tiny even though you've got a proven edge, solid discipline, and plenty of opportunity, so your account technically grows, but so slowly it barely justifies the effort. The other version, you're chasing a quick comeback or a home run, sizing way past what's sensible, and one losing streak wipes out months of progress in an afternoon. The market doesn't care how many correct calls you made in a row before that. One drawdown bigger than your account can absorb is enough to send you back to 0, no matter how well you handled the first 3 stages. How to spot it? If you're the cautious type, your account has been flat for years even though everything else checks out, and you've never had a genuinely great month. If you're the other type, your equity curve looks like a saw blade. Huge green months followed by brutal red ones. And you keep telling yourself, if I just sized down, I'd still have it all. The fix: before you take any trade, assign a specific risk amount tied to how strong the signal is. Clearer setups get a bit more size, weaker ones get less, but always inside a fixed range you decided on beforehand, never in the moment. At the end of each week, check whether you actually stuck to that range, completely separate from whether you won or lost. Coming back to Jake and Tyler, here's what's interesting. These 4 stages tend to show up in order, and trying to skip ahead usually backfires. If you don't have a proven method yet, worrying about position sizing is basically pointless, because you'd just be carefully managing risk on something that might not even be profitable. If you've got a method but can't execute it, piling on more opportunities won't help, because you'll keep executing them wrong too. Tyler's current problem, not enough setups, is a completely different animal from the problem Jake had 3 years ago. No proven method at all. Even though on the surface, both would say they're struggling with trading. This is exactly why the same advice can be brilliant for one person and useless for another. Meditate to control your FOMO is fantastic advice if you're stuck in the execution stage, and completely irrelevant if you don't even have a method worth feeling FOMO about yet. Advice only works when it matches the actual stage you're in. These days, every few months, Jake sits down and asks himself one question. If I could only fix one thing this quarter, what would move the needle the most? The answer changes over time. Some quarters it's execution, some quarters it's finding more setups, some quarters it's tightening up risk. But the real shift is that he's stopped trying to fix everything at once, and he's stopped burning time treating the wrong problem the way he used to in those first few years. If you're watching this, take 30 seconds and ask yourself that same question. Not what should I learn next, but what's actually holding me back right now? The answer might surprise you. Drop a comment with which of these 4 stages you think you're in right now. You might be closer to Jake's story than you think.